Hi guys, hope you're having a wonderful day wherever you are, and more importantly, you enjoyed the last Q&A session we had, plus a very insightful conversation we had with Just Eddie regarding, of course, his entry into the financial markets. Other than that, how are you doing, Rufus?
I think I'm enjoying my day today. I think we had the slowest trading day on Monday, and markets were just moving sideways. But from Tuesday, I think we have had some good volatility, so the day is good.
Yeah, for context purposes, this episode is being recorded on Wednesday, the 30th of August. So we haven't seen what NFP will do, but the JOLTS news has definitely driven the markets. You have said something, the market has been slow. And regarding today's topic, they normally say trading is 1% execution, 99% waiting. Maybe, I don't know how you understand psychology. I think we can begin from there, trading psychology.
Yeah, I think psychology is particularly important for any trader out there because the mind that you normally use in your day-to-day life doesn't necessarily have to be the one that you use in trading. So sometimes a lot of common things that you use in your day-to-day life can work against you in your trading journey. So that's why it's important today we talk about psychology and learn some of the things that affect you even though you don't know about them.
Yeah, just to stretch it a little bit, everyone has their biases, depending on how your strategy is working. I think the biases arises from different factors. I want to assume, number one, if person is trading on fundamentals, maybe it's following what is happening in the news. Case in point, today and yesterday we have had a low job openings. So that indicates a very weak dollar and a high demand for gold. But we know in the market there is usually that room for retracement. So anybody who is looking at the chart maybe on a daily time frame, they are convinced the rally will continue. But if you look on the smaller time frame, you are looking for maybe a short retracement in price. Does that bias play a big role to a lot of traders? Or it is where gambling now comes in? You are just buying, selling without any, thought through.
Yeah, it happens a lot. And it doesn't just happen to beginner traders. It happens to everyone, to the best of us. So it's more or less about how strong your defensive system is in identifying your own psychological bias. For instance, have you ever held a position? Let's say you've done your analysis, you've identified that gold is going up. Then you go for a buy trade. You're observing the trade, moves up, let's say about 100 pips. Then on the next hour, starts moving back with a small candlestick. You are still in profit, but it's down. You are at 80 pips. Keeps going down, gets to 70. You start convincing yourself, oh, this is just a retracement. This is a big winner. I'm willing to ride it higher. Keeps going down, and eventually you find yourself closing at zero. Have you ever had that scenario?
Yes. A lot of times. I think for me, and I follow a lot of, say, fundamentals to determine my long-term view, right? So I might look at, let's say, there is a natural calamity happening. There is an oil tanker explosion happened. I guess from what I'll be describing, you'll know what I like to trade a lot. Yeah. So there is that. What else? Ukraine, why is continuing to go on? The strategic reserve is like today we have EIA report, it comes down that they have, let's say, depleted all their savings or the oil they had in the reserves. And then maybe Hurricane Idalia hits. So definitely demand for fuel will be high because generators will be working. And I don't think electricity transmission from Tesla stations or whatever will work. Now, you already have that. You look at the technicals, $79 a barrel, it's not bad. But the market is still going down. The market is going down 75, you still believe. We are still in this position. I think how I normally approach it, I wait for the comeback and then take an acceptable haircut rather than risking the entire portfolio on something that is giving you sleepless nights rather than just, doing it as early as possible.
Actually, there's a name for it. It's called the house money effect. It affects most people differently. For a beginner trader, if let's say you deposit $1,000 in your trading account, and then you trade for a few months, maybe 1, 2, 3 months. So when you've doubled your account and now you have $2,000, a majority of beginner traders will be thinking, I have my original capital of $1,000, and then I have an extra $1,000 to play with. So you'll find that they're even taking bigger risks because they feel like they didn't have to work hard to earn the extra 1,000. So if let's say they were going for $20, $30 risks, maybe they move to $50 or even $100 risks. And that can be quite negative because you might even end up losing everything in your account.
Yeah, I think it's something that I guess with experience you get to know about it. I think for me, how I view it, if you have $1,000 and all your trades for the day have achieved your target, maybe you're targeting $500 for the day or a week, whichever your target works. I think that psychology begins from the capital you have, how you want to manage it. Secondly, it is not rent, school fees, fuel money, or any emergency fund. It is something you understand that it can be lost, and therefore you are not really worried about it. What you are looking at is how long can I survive with this amount of money for an extended period of time. So I think to address the issue of hopeful position holding, I look at if today I normally hit maybe 100, let's say, should we put it in percentage? I think that, or dollars, it makes sense that way. You have earned, typically you target $100 or $1,000. Once I achieve that, any risk I take is a very low risk for me because I'm just trying to add an extra amount of dollars to the account. I already have the core target for the day from the good setups, and then now any additional, it's a low risk entry you take so that you don't, I call it either, I'd say it's better I preserve my cash for tomorrow than try to risk it all for just one extra dollar. It doesn't make sense to me.
Yeah, it reminds me of an example. I was having this session with another market analyst and trader. His name is Kehinda Erastas. I remember this time we were having a conversation about this, and he said he was targeting to make $50 for the day. So the markets happened to be really volatile, and he made some good cash. So instead of making 50, he closed his positions at $99 for the day. And the way we think in terms of round numbers, if I asked you about the Kenyan population, you would say something like 50 million. You won't go into details, 50 million, 400,000. You won't go there. You just round it off to the nearest number. If I asked you how much you bought your phone, you would say a round number, maybe 50K. Maybe it was 40,430, but you just say 50K or the nearest round number. So he had made $99, which is way higher than the target for the day. But then he needed to achieve that round number. So he went back to the market in search of the extra dollar. So he wanted just to make a very quick trade, make the $1, and he would now close the day with $100. And that one mistake ended up wiping the $99 he had made for the day.
Yeah, it's actually sad. You know how I approach that whenever I'm in such a situation? I withdraw the profits so that I know this money is in hand, it's in the pocket. So we are not going again risking some, I don't want to call it fictitious, but unrealized gains because you haven't touch the money. So I put it maybe in a wallet or just get it out of the system, yeah? And then now you go and look. Because your psychology, your mentality by that point has changed. You are not getting in to make that extra dollar. You're getting in any other trade as if you are starting again. I think there is this quote I go by, every trade you enter, it's like the first of 100. Yes. It's not the third of 100, it's the first. So you make sure you have done your due diligence and therefore you enter. I think there is this other thing besides that, fear of missing out. Yeah. So I believe that one was a spike and therefore it went overboard to what you are targeting.
Yeah.
And then you're like, I think the momentum is still going on.
Yeah.
apparently that's where the momentum died.
Yeah.
Wherever it is, that is where momentum died. So it just starts hovering.
Yeah.
There is no great torture other than buying at the peak.
Buying the top.
Buying the top and now start hoping.
At the upper shadow, at the tip, that's where you entered.
You start becoming a philosopher. A philosopher, reading all the books about patience, checking in and out. You are so worried about it that if at all it shows signs of reversing, and you know at that point, instead of the normal maybe 0.1, you have gone the full yard, one full lot. So you have risked 10 times the initial normal.
So you keep adding positions, hoping it will get back there.
So you start selling again, and then for some reason, the momentum keeps on going. Now it's as if it noticed, okay, so you want to do the opposite, no?
No.
I think that is where a lot of traders coming. I have a very classic example where right now NVIDIA is, right?
Yes.
I think it's at the top. It can continue going. But would you take that risk? That is the question, right?
So I wouldn't be buying NVIDIA right now, learning the lessons I've learned over the years. One thing I know is that if there's an opportunity in the markets and every single media company is talking about it, you go to CNN, you go to CNBC, you go to Jim Cramer, you go to Reuters, Yahoo Finance, every top article is about NVIDIA. So that basically tells you that there's some form of mania and sentiment driving the markets rather than rational thinking. So if there's a lot of traders participating and talking about an asset, in most cases, the opportunity is almost out. And in many cases, you'll find that the market will behave in the complete opposite direction. So whenever I see FOMO, which is usually sometimes in form of an asset bubble or overreaction in the market, I always try to take a step back because in most cases, you'll get wiped out.
Yeah, that is a lesson. I would prefer you learn it in the markets and by taking small risks so that you don't expose your account.
Sometimes the way you learn it is when somebody else mentions that to you, and then you start observing it in the markets, and you are like, wait. If I had made an entry here, I could have burnt my fingers. And then you start learning how to avoid such scenarios.
Yeah, definitely. I normally see a lot of traders, maybe in regards to that, you want to learn everything. So you are taking up on indicators, you are taking up on different names of the same thing, support and resistance, and you're trying to apply all the strategies that work. And every time, because it has worked maybe on a book, it has shown the pattern, and you ignore fundamentals because at the end of the day, most people ignore it because they believe technicals will run the day. Not forgetting, I think I usually like this phrase. Technicals is like the road to Mombasa. Fundamentals is the fuel. If you don't have it, you will not reach there. You will come somewhere. So if you don't understand where the fundamentals are driving the bigger picture, you might not see the short-term positions or opportunities that you can leverage on. So I normally recommend, I think what I've seen work, you work with a system that works. You know you expect maybe $100 from every trading opportunities you make and maybe a certain lot size. And then with the technicals or everything else you learn, you simplify everything to understanding the candlesticks. Like it has worked, so you don't change it. You just keep at it. If it doesn't work, take a pause, go touch grass, go swim, forget about the markets for a minute, and then come back objectively. Take small building blocks to where your position size was, and that makes it more or less like good investing, reliable investing with the expected returns whichever day you trade. You know the worst that can happen and the best that can happen.
I think what I've seen over the time is that traders will make this mistake by having the wrong mentality about the markets. Like the moment you wake up and then you open your laptop, if you don't have any trades, then you are looking for a trade. And that's the wrong approach. You're supposed to be looking for a trade setup and then wait for it to play out so that you can know when to enter the market once the setup has played out. So most traders will be opening their charts, doing research, and then applying different indicators, trying to squeeze in a position, even if no opportunity is present in the markets. So when they do so, you'll find them mostly using out of technical indicators. So you load in your MACD, you load in your moving averages, your RSI. So you're trying to justify something that is not there. So you're basically feeding into your own confirmation bias. So you want, let's say you think or you have an initial proposition that gold is going up, but you don't know whether to enter or not. So you load the RSI. RSI is saying overbought or oversold. And the next thing, you load a couple of moving averages. So, yeah, there's a crossover here. Then you load another indicator and you just keep on feeding your confirmation bias until eventually you go for a position, and then the market moves in the complete opposite direction and you are wondering, oh, these indicators don't work, but you are not patient. You didn't have a trading system. So the correct approach is to have like a set of indicators that build up into a trading system that develops a trading signal. Test this system, make sure you backtest it to see the results, and then you should apply this system on your charts. And when you are looking at the markets, you are waiting for the market to fit the definition of a trading opportunity that you have predefined. And once that happens, that's when you go for a trading position.
Yeah, you see what you have just said negates this question of which is the best time to enter. Yeah. You don't follow the time, you follow the structure that it gives. Yes. Somebody told me back then when I was doing charting, your chart looks like a cobweb. So what you need to do is eliminate all the noise and focus on this. Yeah. And I have a question for listeners. I hope you'll get very interesting answers. I don't believe in two concepts, overbought or oversold. I don't think those levels make sense to me, because as long as the fundamentals show the potential of a higher price, then there is no technically overbought levels, especially if you're using RSI.
Can I give you my answer?
Yes.
So for most indicators, technical indicators, they are basically based on a formula. So they are telling you something you already know about price, but then they are telling you a quality about a price. So if, let's say, you're using something that they like the RSI, which basically is the relative strength index, which basically measures the strength of bullish versus bearish candlesticks. When it says overbought, it doesn't completely tell you like the market is overbought. It's basically indicating that there has been a period where bulls have been stronger than bears, but then it doesn't tell you that the market is reversing. It's a double signal. So it's only informing you that the bulls are really strong, and that could mean either of two things: that there is a strong bull market or the market is overbought. So it doesn't exactly define that this is the point now to sell or to buy. So when you're using these technical indicators, you're not supposed to be looking for the indicator to get to a certain level so that you can buy or sell. So you want to combine several key aspects about price and then combine that with your analysis. Let's say you have done your fundamental analysis and identified that the strong momentum that could come from this and push the price from here to there. And then when you look at your indicators, then they can give you a way of refining your trading idea, where let's say you have an idea that the dollar will go up today. So if you apply your indicators on pound USD, euro USD, USDN, then you can select which trade is best to go for.
Okay.
Yeah.
Potato. But I think you're on my side. Yeah. Just, with a very good background explanation as to why.
Yeah.
As we wrap up, I think maybe the next recording you'll be doing after the iPhone 15 launch around past September 12th.
Yes, and of course, we'll have more information on the situation in Gabon.
Yes, definitely. The reason I'm bringing up that is because of recency bias. So everyone will be looking either to continuously buy even the price is stopped out, or sell because they believe it will flow, right? So I think as traders, maybe what are some of the biases that you think you're facing as a trader? I'd like to see the responses on that, and then we'll touch that, I think, on the next recording, because I expect a lot of varied opinions regarding that in particular.
Yes, I also want to push a question to our listeners. What are the key mistakes that you made when you are starting out as a trader, and then you realized it's because of your psychological biases or the way you think that caused those mistakes rather than the market or the technical application in the markets.
I think traders will write a very good book if we were to get novels on the
Don't think-
journey of trading. Those are very interesting and sad stories to some degree. Other than that, I hope you have learned one or two things about psychology. We will definitely try to respond to any queries possible. For those who do not have an account with FXPesa, of course, you can always click on the link below this podcast. I'm sure from whichever DSP you listen to, Spotify, Google, Apple, and the rest, we are always open for questions, clarity, and of course, your experiences.
Yeah, this was a very short episode. I feel like we should have done more. I think we need to do an episode 2 on trading psychology.
After the questions, we'll go on that. I think we can build on that because I expect the responses and then we try and build up on that.
Definitely.
Yeah, as the Gabon simulation continues. Other than that, guys, it has been real. Happy trading. And, let's meet after the NFT.
Thank you. And make sure to share the podcast.
All right. Bye.